Good afternoon and welcome to the lecture 30 of ETC 779. In the previous lectures, we discussed about working capital, how do we calculate the working capital. Then we also discussed why working capital is important for running a construction company, and for that matter any company. Now in this particular lecture, we are going to learn about the different sources for financing of working capital. We will discuss about the short term financing sources, we will discuss about the long term financing sources, and then towards the end of this lecture we will be discussing different ratios that we need to calculate in order to interpret the health of a particular company. So, we will see what are the different types of ratios that are calculated, what are the utilities of these ratios. So, these are the some of the objectives of today's lecture. Then towards the end of this lecture, I will just try to summarize whatever we have learnt in this particular course, since this is the last lecture for this particular course. So, we will move straight away to the financing for working capital part, and there as you can see we have got two types of financing sources. One, we call them short term financing sources. For example, there could be internal sources for short term financing, there could be external sources for short term financing. Under internal sources, we have got depreciation fund. If you try to recollect some of our previous lectures as far as construction accounting is concerned, we had discussed that depreciation for accounting purpose is considered as an expense, but in real situation the money is not flowing out of the company. So, what is happening? It is just for accounting purpose that we are considering that as an expense. So, in fact, the total depreciation amount also is available with the company to raise its working capital requirement or to cater to its working capital requirement. Now, we move on to other types of short term funds. Under internal sources, we have taxation provisions. If you try to recollect your profit and loss account, at the time of preparation of that profit and loss statement, in real life situation you may not have paid taxes. So, you may have certain amount of money with you as far as payment of taxes is concerned. So, if you find that if you have to meet certain requirement, you may even utilize that particular fund also. Similarly, you can have the funding from the accrued expenses that the company maintains with it. Now, moving to the another types of short term funds, we have external sources. In that we can see trade credit, then you have cash credits, overdraft facilities, then bill discounting, letter of credit, and finally loans less than 12 months duration. So, these are some of the sources which are characterized under external sources. Now, we will discuss each of these financing sources in brief in next few minutes. So, if you try to recapitulate, we have different types of sources of finances which are there for meeting the working capital requirement. One is characterized as short term sources, under that we have internal sources, and then within that we have external sources also. So, now under external sources, these are some of the mechanism through which the company mobilizes its requirement for working capital. We have trade credit, we have cash credit, we have overdraft facilities extended by certain banks, we have bill discounting facility, we have letters of credit, and we have loans less than 12 months duration. Now, we will try to go to each one of them briefly, and then we will proceed to the long term financing sources. Now, trade credit, they are very common in construction industries. You might have, those of you who have worked at some of the construction projects, you might be finding that it is a very common thing in construction industry. So, whenever the company wants to procure certain material or certain other things such as fuel or petrol or some other consumable items, they do not pay in cash to the suppliers. Normally, the suppliers extend certain credit period. The normal credit period observed in construction industry normally is between 4 to 6 weeks. If your company is good, they can command greater extended credit periods. It could be even 8 weeks also. But more than 6 to 8 weeks credit is normally not desirable, because once you have such a long credit period, then your suppliers start loading the interest charges also into the rates that they offer you. So, neither it should be too short nor it should be too long, just on an average it should be between 4 to 6 weeks duration. Now, these trade credits, they are having very few restrictions and they are very simple as well as quite flexible also. So, you can negotiate with your vendors, and depending on the requirement you may even change the conditions to suit your requirements. So, that is why this is one of the most favored route for mobilizing your working capital requirements. We move on to bank finance. They are also very important sources of finance. Now, there could be different routes for bank financing. For example, there could be overdraft facilities. Overdraft facilities is you have certain amount of money in your bank in the form of a current account. Now, due to some reasons you require certain money beyond that is there in your current account. So, under such situations the bank may extend, depending on how much goodwill you enjoy with the bank, they may extend certain overdraft facilities. That means you can withdraw more amount than what is there in your bank. Now, these overdraft limits may vary depending on the goodwill, depending on the amount of business you have with the bank. So, all these factors govern the overdraft limit. Now, some banks, they charge you certain interest also on the overdraft facilities that you are enjoying. So, they have a certain amount of charges levied against your deposits. So, these are some of the means through which you raise the working capital requirement. Then there could be cash credit. Similarly, there could be purchase or discounting of bills. There could be letter of credit, which is also known as LC, and then in addition to all this there could be a special loan also. They are called working capital loan. Now, not all the banks may have this kind of bank finance mode available, but depending on the type of business the bank has, they can always tailor made a working capital loan as one of the options to help contractors or to help companies mobilize their working capital. Now, the credits extended by banks could be either in the form of unsecured loan or through some collateral. That means the banks are giving you loan against, let us say, some assets. You may show that, look, I have got asset A, I have got asset B, I have got asset C. Now, you against these assets kindly give me loan. Now, when you talk of collateral, it could be in the different forms. For example, it could be hypothecated, it could be pledging, it could be mortgage, or it could be on lien. Now, there are thin line of differences existing in all the four terms. For example, in one of the cases the asset may be directly with the bank, in another case the asset may be with the borrower. Now, depending on what kind of arrangement you want to have, the banks can come up with different schemes to suit your requirement, and then you realize the amount which is needed for the working capital part. Now, we have certain other sources also for these external system of short term financing. For example, there could be commercial papers. Now, commercial papers concept originated basically in United States of America. Now, basically these are some kind of short term funds which only blue chip companies can raise. Now, these blue chip companies are highly rated companies. So, they have a provision through which they can realize money in short term raising the commercial paper. Now, the commercial paper's maturity lies between 15 days and it is always less than 1 year. Now, commercial papers are available in numbers of denominations. For example, it could be 500,000, it could be 100,000. So, under these denominations commercial papers are issued, and that way the companies realize the requirement for working capital. In India also it came into existence in 1987. So, that way it is also quite old, but the only drawback is that not all the companies have this freedom to utilize commercial papers route to mobilize the working capital. There are very few select companies which can exercise this kind of funding mechanism. Now, we have a new concept, relatively new concept coming up as far as realizing short term finances are concerned, that is called factoring. Now, factoring is basically a process where a firm or the company sells its receivables for cash to another firm, which is known as the factor. Now, these factors they specialize in collecting the money. So, it is like this: suppose I am the contracting company A, I am working for a client B. Now, client B owes 100,000 of company A, right. That means, I have raised a bill of 100,000 for the work that I have carried out for company B or client B. Now, suppose I want urgent money because I am having some problem as far as my working capital is concerned. So, I need this 100,000 immediately. So, what I do is I contact a third company C. I contact a third company C and sell my bill to him, saying that look, Mr. So and so of company B owes me 100,000. So, you pay me that much money, of course, you charge a certain amount of commission from this amount and pay me the balance immediately. Now, as and when the payment terms whenever the agreed payment schedule comes into picture, you collect payment from B. So, it is like there are three parties A, B and C. A is working for B for certain amount of money. Now, that money is not due immediately. So, what this company A does is he is selling all his receivables to another third company C and gets the money immediately after deducting certain commissions, and whenever the payment is due, company C collects payment from company B. Is it clear, technology class? I will try to show it to you through an example. So, let us say I am the contractor A and I am working for client B. This is contractor and client is B. Now, A is working for B, and now let us say for month 1, contractor has raised a bill of 100,000. Contractor A has raised a bill of 100,000. Now, according to the contract condition, B is supposed to pay contractor A after 1 month, let us say. So, suppose this on February 1st, contractor A raised a bill of 100,000. Now, this payment is due on March 1st. according to contract condition. Now, imagine that contractor A wants the money quickly, immediately, maybe on 2nd of February or 3rd of February. So, what it does? It contacts some company C. C is known as factor. So, it contacts factor C and sells this invoice or bill to him, and maybe gets an amount of 98,000. That means contractor C has charged rupees 2,000 as commission. What it has done is, although the contractor A is getting 2,000 rupees less, but he is getting it very quickly. Now, these factors, they are experts of collecting money from different agencies. So, the moment they receive this 100,000 bill from contractor A, they will quickly verify it, check the reliability of client B, and then decides the commission C. I mean, this commission 2,000, it can be even more. If the factor C realizes that the company B is not at all reliable, then he may even charge a higher commission. So, higher the risk, higher the commission. So, this concept, although it is not that popular in construction industry, gradually it is catching up, because most of the time you find that construction companies go bankrupt because they are not able to collect their outstandings or debts in time. So, this particular means of financing the capital is gradually catching up. Now, when this kind of scenario exists in case of export import, we call that system as forfeiting. So, within the domestic area, if this process works, then that process is known as factoring. Now, when it involves a vendor from another country, then this process is known as forfeiting. So, basically this is an extension of factoring in the area of international trade, in which a manufacturer or a supplier from country A is involved. He is selling some products to a receiver which is stationed at let us say country B. Now, there could be a third agency C, which may be either staying in country B or country A. So, they are having the expertise in collecting this kind of money. So, whatever concept we discussed in the context of factoring, similar type you extend it to trade situation, international trade situation. Right now, let us say here this A is the exporter. He is sending some materials to a company B, right. Now, when the deal takes place, the exporter raises a bill to B, and if they want the money immediately, they can have a route like this. They have a different agency which may be either staying in country B or staying in country A or in some other country C. So, this type of services these forfeiters they provide. Of course, all these things are carried out for a commission also, because nobody will do these services for free. So, they have an expertise, they try to evaluate all these deals very quickly, and then they provide you quick services, and in lieu of that they charge you certain amount of commission. Now, we will see long term sources of finance. Now, in this I will just list them out. One important source is retained earnings, then there are issues of shares, then you have floating of debentures, then long term loans. Now, when you talk of long term loans, they are usually between 5 to 7 years period. Then you have reserves and surplus, and then you have fixed deposits also. So, these are different sources under long term funds. So, just to recapitulate, we have a short term funds. Under short term fund, you have internal sources such as depreciation funding, provision for taxation, and under external sources, we had different mechanisms such as trade credits, bank finances, factoring, forfeiting. We are trying to discuss only the important sources of finances, although there could be n number of sources of finances depending on the country, depending on the market conditions, they could vary. But we are just trying to focus on some of the key sources of financing under short term sources and under long term sources. Now, when it comes to retained earning, you already know what is retained earning. So, whenever the company makes profit, the board of directors, they decide how these profits are to be appropriated. That means how these profits should be shared. Now, part of this profit is retained as retained earnings. They will appear under liability column. That means the company's liability has grown up further because it has earned certain profit, and out of that profit a certain portion is kept with the company itself, so that it can invest this money into some different kind of investment options. So, they are one of the very popular sources of financing your working capital requirement. Now, there are different financial instruments such as there could be bonds, there could be floating rate notes, bills of exchange, promissory notes. Now, sometimes these bonds may be issued by very reputed companies, so which go on sale, and private investors as well as institutional investors, they buy these bonds, and that way the company realizes the money for its working capital requirement. Similarly, you have got shares. They are also one of the prominent sources of raising your long term capital. Now, equity shares are issued to the promoters of the company. Then subsequently, when the company grows, it issues shares privately to the promoters, relatives, friends, business partners, employees, etc. And finally, when the company grows, it raises capital from the public in the form of issue of equity shares. So, it is like a step by step process. Initially, the promoters of the companies, they invest, then they get money from their relatives, friends, employees, and then finally, when the company further grows, they get these capital from the public in the form of issue of equity shares. Then you have merchant bank. They also provide loan at some fixed interest charges which can be negotiated. Now, when you borrow from them, they normally have a higher interest rate, but the loan is flexible in the sense that capital and interest repayment can be arranged to suit the company's future cash flow pattern. So, if you find that maybe from second year onwards your cash flow position is going to improve, then you may even work out a deal which has a provision to pay more amount of money during second year onwards. So, that kind of negotiation can be there if you are trying to mobilize the funds from merchant bank. Then again you have a debentures, which is not similar to the loans made to the company at fixed interest rates, repayable at a set time. Now, here also the company's reputation plays an important role. If the company is highly reputed, it will have very few problems as far as issuing, mobilizing funds through debentures is concerned. Now, in case of liquidation or bankruptcy of the firm, the persons holding the debentures have the first right almost ahead of all creditors. So, that way debentures are fairly placed. Now, you have a long term loans. Normally, they are difficult to get because construction, as you must have been understanding, it is full of risk. So, very few banks, first of all, they provide long term loans. So, in the beginning, when the company is just started, you will find that rarely any bank is going to help you as far as giving you long term loans are concerned. But once you have established yourself in the market, you start commanding respect, and then bank also they start giving you loans such as long term loans. Then you have a rights issues. So, all these things I will send you the slides and you can go through them. They are very self explanatory and you will be easily able to understand them. Then you have a venture capital. Now, these are the latest phenomena. There are many venture capital companies which finance depending on the idea that is promoted by the company. So, if they find that the idea may click and they have a good chances of making lots of money, they will finance you. So, you will find there are many such type of approaches possible for IT companies, information and technology companies and finance companies, but not many companies raise their long term funds through venture capital as far as construction is concerned. So, these are very, very new phenomenon as far as construction industry is concerned. Now, this was as far as discussion on different sources of financing of working capital was concerned. So, we discussed two types of sources, short term sources, long term sources. Under short term sources, we had internal sources such as depreciation fund, provision for taxation, accrued expenses. Under long term funds, we had under external sources, we had trade credit, we had cash credit, we had bank finance, we had factoring, we had forfeiting. So, those were as far as short term loans were concerned. Then under long terms, we discussed different routes through which the companies realize their requirement for working capital. Some of the examples are your retained earning, then your shares, your debentures, merchant banking, long term loans. So, the first part of the lecture was focusing only on the sources of finance as far as working capital is concerned. Now, in this part of lecture, we are going to learn about different aspects of how to read a financial report, and then we will see what kind of ratios we should derive while reading through the financial reports and what are the interpretations of these ratios. So, this part of lecture is mainly focused on ratio analysis. But before that, in financial statement or financial report, or sometimes also known as annual reports, you will find there are many statements such as your balance sheet would be there, your profit and loss account would be there, then sources of funds would be there, application of fund statement would be there, many such details, your director's report would be there, your auditor's report would be there, many such informations would be there. It will be a very bulky report, maybe of the order of 100 to 125 pages. Now, if you want to analyze a financial, if you want to analyze the financial health of a particular company, you need to go through them in a focused manner. So, if you look at this particular slide, it is helping you how to read a financial statement. For example, what you should see from those reports. For example, first you should try to see what is the net worth of the company. Net worth is nothing but your share capital plus reserves. Then you must try to find out what are the different components of loans and how much portion has been contributed by owners. Now, the ideal scenario would be 2:1. That means one portion is coming out of owner's fund and two portion is coming out of some other investors, or it could be in the form of loan. Now, more than this, suppose you have got more loans and less of owner's money. As a third party investor, you would not like to invest in such a company, because you will think that the management may not be too keen in managing the company profitably, because there is not much at stake as far as owners is concerned. So, the ideal ratio that has been suggested as far as construction company is concerned is 2:1. Then similarly, you should look for current assets versus current liability. That means the ratio of current asset to current liability. This also should be near about 2:1. That means your current asset must be twice that of a current liability. Now, if you have got this ratio higher, that is also not good. Whereas if this ratio is lower, that also is not good. For example, suppose this ratio is 4:1. Current asset to current liability, suppose this is 4:1. That means the company is too much conservative in its approach. That means for every 1 rupee of liability or for every $1 of liability, company is engaging $4 or 4 rupees. So, the return will get affected. The amount of profit that it should generate for a particular level of capital, the company may not be in a position to manage that. Now, suppose this ratio is 1.1:1. That means the company is going too aggressively. That means for every $1 of liability, it is trying to manage with only $1.1 of assets. So, as an investor, I may doubt the capability of the company to pay its short term liabilities. I may find that some day will come and on which the company may not be able to pay to its supplier, because the current asset portion is very low or very less. So, this ratio experts have suggested that it should be nearly about 2:1. We will see in the context of construction industries what are the ideal ratios that have been suggested. Then when you are analyzing the financial report, you should look for net profit as a percentage of sales. That means how much profit, net profit is you deduct your interest, you deduct your income taxes, whatever is the left out. Sometimes they are also known as EAT. So, what we are talking here is EAT. That means earnings after taxes. So, this is what you eat. Rest everything is going to take care of your taxes, your incomes. So, we are focused on earnings after taxes and interest as a percentage of sales. Suppose my sales is 100. So, how much percentage we have generated as far as EAT is concerned, whether it is 5%, whether it is 10%, or whether it is 15%, where it is 20%. So, you should try to look for this value also. Similarly, you should also look for the ratio of fixed assets to turnover. That means how much sales the company is able to generate with how much amount of fixed assets. Now, if you remember, your fixed assets are land, buildings, furnitures, these things, equipments, major equipments, these are your fixed assets. So, you want to see for generating, let us say, X amount of sales, how much amount of fixed assets you have employed. So, that is also one of the important thing that you must look. Then you must also see the ratio of working capital to sales. For example, how much percentage in terms of your sales value you have employed as working capital, whether it is 40%, 50%, 30% or 10%. The ideal ratios the experts have suggested is 20 to 25%. Now, coming to the ratios that we try to look for when we go through the financial reports, one thing you must try to understand, you should always try to compare an apple with an apple, not that you compare an apple with an orange. The idea is, whenever you are conducting such kind of analysis, it should be conducted for similar kind of companies. Not that you are comparing one ratio for a IT company and another ratio for a construction company. There may be wide differences across different business organizations. So, that is why always try to compare things from among similar things. If you are trying to compare the ratios, you try to compare it only for construction industries or only for IT industries or only for manufacturing industries or maybe only for automobile industries. Then only you can be confident of your analysis as far as these ratios are concerned. Now, when we do this ratio analysis, basically this is nothing but the ratio of one over another. For example, you want to compare two parameters x and y. So, you want to calculate the ratio and you can express them in terms of percentage also. For example, you want to compare the profit is to sales. There could be many ways through which you can compare. For example, you have profit and sales. Now, suppose I tell you that my profit for this year is 100,000. If I talk of this statement alone, will it make any sense? 100,000 for a sales of what? What was the profit in the previous year? By what percentage the profit has grown up? Or whether you have made any losses in profit. Maybe last year you might have earned a 50% profit on your sales. This year whether you have made 60% or 40%. So, if you are trying to express parameters only in terms of absolute values, that is not giving you correct picture. Similarly, if you are trying to say that a company has made 1% expenditure in its 1% expenditure of its revenue on R&D. So, let us say if this statement is like this, the company is spending 1% of revenue in R&D. Now, here also it is not of much meaning to me. For example, I must know 1% is coming to how much amount, whether it is 1,000, whether it is 10,000, whether it is 100,000. So, what you find here is that the absolute values as well as the ratios, they too complement each other. So, if you are talking only in terms of absolute values, that is also not carrying much meaning. Similarly, if I am talking only in terms of ratios, that is also not giving me any information, relevant information. So, these two most of the time we try to club together and then report it. Now, ratios could also be represented in manner like this, 2:1. For example, the profit to sales ratio is 2:1, or it could be 50%. So, ratios we express it either in terms of percentage or in statements such as 2:1, 1.5:1, 3:2, something like this. Now, ratio analysis is basically useful for comparing. So, whenever we want to carry out a study on comparison, it could be the trend ratios, or it could be the inter-firm comparison, or it could be the comparison from the industry standard. So, there are three ways through which you compare with the help of ratio analysis. It could be either the trend ratios, it could be the inter-firm comparison, or it could be the comparison with standards or plans. Now, when I was giving you the explanation on the ratios, I have just one example for you. For example, I have got the data for two organizations, organization A and B. You may note it down. Organization A in year 1 had a sales of 200,000. In year 2 it was 300,000. Now, profit for the same year, that is year 1, for organization A was 50,000, while in year 2 it was 100,000. Now, when you look at organization B's data, the sales in year 1 was 200,000, the sales in year 2 was 250,000, the profit in year 1 was 20,000, and profit in year 2 was 50,000. Now, looking at these data, you can see that as far as sales in year 1 is concerned, both the company had equal sales level of 200,000. Now, the company's A sales grew by how much percent? It grew by 50%, because there has been an increase of 100,000 from year 1. That means, from 200,000 it went to 300,000. So, what you see is that company's A's sales grew by how much? 50%. B's sales grew by how much? It is basically 250,000 by 200,000. How much is it? 12.5%. It grew by only 12.5%. So, this way you can compare that although the sales in year 1 for both the companies were same, the company A grew faster, company B grew in a slower manner. Now, similarly, the profit for company A grew by double, 50,000 in year 1 became 100,000 in year 2. So, 100% increase. Whereas, if you look at the profit of organization B, it went up by 250%. From 20,000 it grew to 50,000. So, here we had an increase of 250% in profit, whereas here we had a increase of 100%. So, such kind of informations we can derive by going through the financial reports of different companies. Now, when we carry out the ratio analysis, we can try to compare the data of different year for the same company, which is called trend ratio, or we can study the similar set of data or similar set of ratios for different companies within the same industry. That is known as inter-firm comparison. Whereas in the third type of analysis, you try to compare with the best in the industry. So, suppose there is a company XYZ and you want to study the performance of that company through different ratios. We will see what kind of ratios we calculate. So, let us say the ratios are A, B, C, D, E. So, these ratios A, B, C, D, E, we will try to study for, let us say, past 5 years, and then we will try to infer the result, whether the sales is growing, whether the working capital employed is more or less over the years, whether the profit is growing at a good rate, whether the company is increasing its fixed asset over the years. All such informations we try to study under trend ratios. For example, it will be something like this. In trend ratio, let us say there are different ratios A, B, C, D, E. Let us say we are studying these 5 ratios. This could be year 2000, this could be year 2001, 2002, 2003, 2004. So, like this we will try to compile the data against each of these ratios A, B, C, D, E and so on, and then we try to interpret the results. So, this is what is known as trend ratios. Now, this exercise is conducted only for a specific company, because the same company's data you are trying to study it over the long period of time. Now, when it comes to inter-firm comparison, what we do there? Let us say you have an inter-firm comparison. In this, what we do is, I have different ratios, let us say A, B, C, D, E, F. Now, there are different company, let us say company C1, company C2, company C3, company C4, and let us say this is your company XYZ. So, you will try to compare different ratios for your company vis-a-vis other companies operating in the same industry. So, this is how we carry out the inter-firm comparison using ratios. Now, the third one under ratios study is rather a comparison with standards or plans. So, in that what we do, we try to list out different ratios, comparison with standard, or planned. So, here you have different ratios A, B, C, D, E. Now, this, let us say your company's name is XYZ. Now, industry leader is, let us say, TOP company. TOP company is industry's leader. Now, each of these ratios will be compared with the best, and then you have to see where you are in terms of the ratios which is achieved by the top performing company within the same industry. Now, if you do not want to do this analysis, because you find that the top is at very high level and you can't go there in simple one step. So, in that case you have a target. For example, the ratio for the value of ratio A is 1:2 right now, and you have a target to reach it to 1:1.5. So, this target versus the actual thing you try to study, and then you take appropriate measures so that you are as close to the target or you are as close as to the top company of that particular industry. So, this is how we carry out the three analysis, namely trend ratios, inter-firm comparison, as well as comparison with standards or plans. Now, we will see what kind of ratios are commonly used. There are n number of ratios. We will not get time to cover each one of them in detail, but I will just try to summarize and give you the brief ideas of some of the very commonly used ratios as far as construction industry is concerned. So, if you try to have a look at the different ratios, they are classified under four main categories. I will read it out. The first one is called liquidity ratio. The second one is capital structure ratio. The third one we have is profitability ratio, and finally the last category of ratios are activity ratios, or they are also sometimes known as efficiency ratio. Now, you will find that each of these four categories of ratios have a specific objective to attain. For example, we try to see the liquidity ratio in order to find that whether the company would be in a position to meet its short term liabilities. So, as an investor, if you would like to know whether the company is financially sound and whether it can cater to the requirements of its short term let us say short term liabilities. In such scenarios, you try to calculate the different liquidity ratios. We will see what are they. Now, when it comes to capital structure ratio, as an investor, this ratio will try to tell me whether the company is in a good position to meet its long term liability or not. So, liquidity ratio is for whether the company is meeting the short term liability. Capital structure ratio is to know whether the company is in a position to meet its long term liabilities or not. When it comes to profitability ratio, the investor would like to know whether the company is maintaining a decent profit or not. And finally, when it comes to the last type of ratios, activity ratios, the investor would like to know whether the company's assets, they are utilized properly or whether they are having good kind of efficiencies or not. So, the four objectives: whether the company can meet short term liability, second, whether the company can meet long term liability, the third, whether the company is in a position to maintain a decent level of profit, and fourth, whether the company is able to operate its equipment, operate its other assets in a most efficient manner. So, these four objectives are tried to these four objectives are basically evaluated using different ratios. Now, we will go to each one of them. For example, when it comes to liquidity ratio, you have three types of ratios. The first one is current ratio. For those of you who are not able to see, I will write it here, so do not worry. This is under liquidity ratio. Liquidity ratio. Here you have current ratio, we call this as CR, and here you have acid test ratio. So, these are the two main things, current ratio and acid test. They are also sometimes known as quick ratio or liquid ratio. Now, current ratio is nothing but the ratio of current assets to current liabilities. Current ratio is nothing but current asset, we write it CA, divided by current liability CL. And for construction companies, experts suggest that this ratio must be more than 1.3:1. So, this ratio must be more than 1.3:1. That means, for every $1 of liability that the company has, it must have at least $1.3 of assets available in the current form. So, this ratio is telling the investor that look, the company is sound enough to meet the requirement of its short term liability. That means, the company will not go bankrupt when it comes to payment of its different suppliers, its different vendors. Now, one other ratio, which is acid test ratio, is sometimes considered more realistic in estimating whether the company is in a position to meet its short term liability. So, when it comes to acid test ratio, this is defined as, if you look at this particular slide, quick assets divided by current liabilities. This is defined as quick assets to current liabilities. Now, if you try to recollect, in current assets we had many components. There was cash component, there was bank balance, there was inventories. Now, when we calculate the acid test or quick ratio from the current asset component, we exclude inventories, because inventories will take time to convert to cash form. So, there we delete that part, and thus quick assets are only your cash and bank balances or maybe some deposits, which can be quickly withdrawn and which can be used to meet the requirement of your suppliers, your vendors. So, experts suggest that this particular ratio is a good indicator of the ability of the company to meet its short term liability. Ideal ratio as far as quick or liquid ratio is concerned should be more than 1.1:1. That means the company should have at least 1.1 times of its liability in either the cash or bank balances or deposits form. Now, I have worked out a small example to explain you how do we calculate quick ratio, how do we calculate current ratio. So, you can note down this problem. In this particular example, let us assume that the cash that has been maintained is 2000, debtors are 2000, inventory is 12,000. The total current assets, which is A plus B plus C, is coming out to be 16,000. Now, if you look at the total quick assets, that is the sum of only A and B, that is cash and debtors only. It is excluding inventory. So, that is coming out to be 4,000. Now, suppose that the total current liability is 8,000. So, the current ratio will work out to 16,000 divided by 8,000, which is 2:1. Whereas the acid test ratio is coming out to be 0.5:1 only. That means the company is not that financially sound and there is a doubt in its ability to pay its short term liabilities or current liabilities, because you can find that the ratio 0.5:1 means that for every $1 of liability that the company has, it is maintaining only $0.5 of asset with it. That means the company is going in a more aggressive manner. It is taking too much of risk. Tomorrow it may even go bankrupt because it may not have sufficient money to meet its requirement, to meet the requirement of its suppliers, to meet the requirement of its vendors. So, investors would be very susceptible in investing in such kind of firm. Now, we move to next type of ratios, which was the capital structure ratio. Now, as I told you, these capital structure ratios are meant to check the long term, check the capacity of the company as far as the payment of long term liability is concerned, because investors would like to know whether the loans will be repaid, whether maybe in single installment or maybe in multiple installments, that is altogether different matter, but they want to be assured that whether their money that they want to invest in this company is safe or not. Now, this is basically trying to find out the long term soundness or the solvency of the company, whether the company is sound enough financially that it will meet the long term requirement, long term liabilities. Now, here also there could be two types of broad ratios under capital structure ratios. You have a leverage ratio and you have a coverage ratios. Now, these leverage ratios are calculated from the balance sheet, while the coverage ratios are calculated from the profit and loss account. Different types of leverage ratios are debt equity ratio, debt to asset ratio, equity asset ratio. Now, the ideal as far as a construction company is concerned, the debt to worth ratio must be less than 2:1. That is what the experts recommend. Now, the coverage ratios are calculated from profit and loss account, and there could be different types of coverage ratios. For example, it could be interest coverage ratio, it could be dividend coverage ratio, it could be total fixed charges coverage ratio. And the definitions also are very simple. For example, interest coverage ratio is earnings before interest and taxes divided by interest. Likewise, the dividend coverage ratio is interest after taxes, earnings after taxes to preference dividend. Now, the details of these ratios we are not going into. You can refer to some financial books on some financial management. There you will have detailed treatment for each of these ratios. And going into too much detail is also not relevant for us, because as far as we are concerned, we must know what are the different ratios, what are the objectives of calculating the ratios, and what are the ideal suggested ratios, so that we can always check our company whether it is doing all right or whether it needs certain improvement in certain areas. Now, we move on to next kind of ratios, which is known as profitability ratio. Now, for any commercial organization, as you would expect, profitability is the key term, because until unless the company maintains profit, the investors will not be putting their hard earned money into this particular company. And another thing with this profit is that a large chunk of profit is retained as retained earning, and they are utilized for maybe financing the working capital and so on. So, it is very important for an investor to understand whether the company maintains a decent level of profit or not. Now, the profitability ratios have been defined to establish the quantitative measures of the profitability of a firm, and definitely are of interest to the owners, the management, the creditors, as well as for regulatory bodies. Now, these ratios can be determined on the basis of either the sales or the investments. Now, there are different profitability ratios classified under profit ratio, expense ratio, as well as those related to investment. For example, in profit ratios you have, I know this slide is not that clear, but I will be sending you these slides. The gross profit ratio is the ratio between gross profit and sales. The net profit ratio is the ratio of net profit after taxes and interest to sales. Similarly, you have operating profit ratios. Under expenses ratio, you have operating ratio, operating expense ratio, cost of goods sold ratio, specific expense ratio, financial expense ratio, and so on. And lastly, you have activity ratio. They are also defined, they are also known as efficiency ratio. Now, these, as I told you in the beginning, these ratios are indicator of whether the company is utilizing their assets in a most efficient manner, because until and unless assets are maintained in most efficient manner, you will find that it also affects the profit and other aspects. So, for an investor, it is also of importance to know whether the company is utilizing its different assets in an efficient manner. Now, depending on the different types of assets, you have different types of activity ratios. For example, you have inventory or stock turnover ratio, you have receivables turnover ratio, you have assets turnover ratio. Under these, you have got different sub ratios, so which I am not going to cover in detail. So, this is as far as discussion on different ratios are concerned. So, in this particular lecture, we discussed the different sources of financing of working capital, and in the later part of the lecture we discussed how to interpret the financial report, as well as what are the different ratios, how they are calculated, why ratios are important. So, this is as far as this lecture is concerned. Now, I will just try to quickly summarize whatever we have covered in this particular course. So, if you try to look at the total lectures that we have covered, we started with the time value of money. There we saw that $1 now will not be of same worth, maybe $1 after 1 year. So, that means the dollar or the rupee has got time value attached to it. And using these time value of money concept, we tried to try to find out how to evaluate different alternatives. We learned different methods such as present worth method, such as future worth method, rate of return method, internal rate of return, external rate of return, incremental rate of return method. Then we tried to see what are the impacts of taxes and depreciation on our decisions. Now, these decisions were taken assuming that whatever the estimates we have prepared are accurate, right? There are no inflation. So, under these circumstances, we developed certain formulas and developed certain procedures to evaluate different alternatives. Then we started violating each of these assumptions and then tried to make the problem little complicated. So, first we tried to incorporate the uncertainty in different estimates. So, we conducted sensitivity analysis. We tried to find out which variable is more sensitive, less sensitive, or rather insensitive. Then we tried to look for break-even analysis, which is nothing but an extension of sensitivity analysis. There we tried to locate the break-even points. These break-even points we defined as that particular point at which the company is just able to recover its cost. So, we studied linear break-even analysis, we studied non-linear break-even analysis. Then under linear break-even analysis, we studied multiple product sensitivity analysis, we studied the phenomenon of dumping. Then we moved on to risk analysis. So, before risk analysis, whatever discussion we had was of non-probabilistic nature. In risk analysis, we took different probability values into our account and then tried to evaluate different alternatives. We tried to answer which alternative is risky, which alternative is not risky, which project proposal has high risk, which project proposal does not have risk. So, these things we discussed under risk analysis. Now, these discussions were as far as private projects were concerned. We discussed our public projects evaluation also. There we discussed more on benefit cost analysis. We saw how to calculate benefit cost analysis. What is benefit? What is cost? How do we evaluate when there are more than 2 public projects competing for the similar funding? So, that was discussed under benefit cost analysis. Then one more thing we discussed, that was replacement analysis. So, there we tried to find out at what point of time it is best to replace a particular operating equipment. So, we discussed different types of replacement analysis process, and then finally, we tried to calculate different costs associated with the operation of a particular equipment, and wherever we were getting the lowest value of cost, we were selecting that as the replacement age of that particular asset. So, this was as far as replacement analysis was concerned. Now, then we shifted our discussion to accounts. There we discussed what is accounting, what is construction accounting, why it is different from other accounting, what are the different methods of recognition of revenue in construction contracts. We discussed the different steps through which accountants prepare the financial statements such as balance sheet, profit and loss account. We discussed the different components of balance sheet, what are the different components are there, what is fixed asset, what is current asset, what is liability, what is current liability, what is profit. All these things was discussed under profit and loss, and then we moved on to different parts of accounting, such as we discussed the different types, we discussed what is meant by working capital. Then in this class we discussed what are the different sources of working capital, and then finally we concluded it with the ratio analysis. So, this is what we have covered in this 30 lectures. Hope you have enjoyed it, and in case you have got any doubt, we will try to take it now, or else anyway we are coming to Ethiopia to address all your concerns, to address all your queries, and whatever shortcomings were there, we will try to address there. So with this I conclude this lecture, and thanks a lot for all of you, to all of you, for patient hearing. Thank you. Thank you. Yes, please tell me. Yeah. Thank you. Oh, okay. Thank you. Thank you. फाइनली खत्म हो ही गया.